With regards to the yen, I mean, we've learned the hard way the amount of epic leverage that had been built up globally into the yen carry trade when it suddenly unwound and caused a massive seismic ripple through global markets. Is it a threat to global market stability, or is that really overstating things?
Well, Mandy, I would hate to say that you ever overstate things, but I really think that's the result of a lot of highly over-leveraged marginal hedge fund managers bailing out of the yen when they got slightly squeezed. But it's not reality. The reality is that the yen carry trade is currently well over 4% against the US dollar and 2% against the Deutsche Mark, and it's going to be approximately there or close to it, maybe 3.5 against the dollar, but still highly profitable in 2 years' time from now, because by any path you cannot see interest rates in Japan matching those in the US. So the carry trade, fine. The other thing is Japan has got $9 trillion worth of overseas assets on a net basis. Now, a third of those, so 3 trillion, is actually portfolio investment. And you have to ask yourself, will this portfolio investment go back to Japan simply because it's having a faltering policy to tighten the supply of money, to increase interest rates to some sort of level that corresponds to the situation in the economy, which is kind of halfway rational? And the answer is, I don't think the way that Japan is managing itself or the path forward in interest rates is in any way sufficient to suck money out of global markets as Japan repatriates its assets. So my feeling is no, it's not going to, in reality, it's going to hurt some hedge fund managers, but it is not going to suck liquidity out of the global markets, lead to a market crash.